I believe I may have cracked the code on the recent market crash, something that the financial elite do not want you to know, and I'm going to explain in detail how it can all play out and that something far worse could be coming. Aren't you curious how a previously little-known secret, aka the yen carry trade, unwound trillions of dollars from the stock market in a matter of days? Curious why they keep saying it all happened on Monday, August 5th, when in reality it began on Thursday, August 1st, the day after the Japanese unexpectedly raised their interest rates by 25 basis points? Stick around because this could get messy. As always, nothing I say is financial advice. First, to understand what crashed the markets, we have to understand a little about how markets work. Don't worry, I'm going to explain everything. Huge financial institutions with billions of dollars at their disposal, called market makers, add liquidity to the market. For example, they make it easier and often cheaper to get into and out of the market. We are told that for every option they sell short, they are hedging against that option so that, on net, they aren't making or losing money on the option and are instead just making money on the spread between the bid and the ask. The bid is the price someone is willing to pay, and the ask is the price someone is willing to sell at. They would hedge calls by buying shares of the underlying asset, for example SPY, and they would likely hedge puts by shorting the futures market. But what if, and here's the kicker, they aren't hedging, or aren't hedging fully? The powers that be are the ones with enough money to actually move the markets. If my hypothesis is right, many of them are not hedging, and this is where the trouble starts. When the market is going down, people pile into put options because they believe it's going to go lower. The market makers sell these puts to them for, say, $200 a piece, times thousands. Then, because they actually have the money to push the markets up, they do. All the while selling calls to the people who now think it's going to the moon. Once price is high enough that those puts are far enough out of the money, now they can buy them back for, say, $30 a piece, pocketing the difference. Then they can sell the shares that they bought to force the market up back into the market, tanking the price. Then, as those calls go further out of the money, they can buy them back for pennies on the dollar. Then rinse and repeat. So in that way, they're pocketing premium from shorting options, plus pocketing long and short share money, further increasing their ability to continue the process. This would likely be accomplished through algorithmic trading, where you would be competing against a supercomputer that fully understands and knows how to manipulate human psychology. Sort of like letting the genie out of the lamp, but the genie only serves its master and is willing to cause harm to others. I hope I haven't lost you, because here's the real kicker. If they are doing this on borrowed carry money, it would likely take very little to rapidly unwind the whole trade. For those of you who don't know what a carry trade is, let me fill you in. Someone with far bigger pockets than us shorts the sovereign debt of a company, aka bonds. We'll use the Japanese yen as an example since that's what most recently blew up, but carry trades can happen with any country. Just like JP Morgan recently called it, there is actually a global carry basket out there right now. So they short bonds, selling something they don't own on the open market to get yen. Then they go into the foreign exchange market and buy US dollars with those yen. Keep in mind that it takes many more yen to make a single dollar, so they better have a lot of them. Then they go into the US market and buy US assets. If they were being smart and safe, they would buy US treasuries like notes because they are short-term debt with a significantly higher yield right now than the Japanese bonds. So they'd be pocketing about a 5% guaranteed difference minus forex fees and the risk of a strengthening yen versus weakening US dollar. We'll get to that in a minute. Instead of being safe, it appears far more likely that they are using this money to short volatility, which has been compared to picking up nickels in front of a steamroller. Sure, you might get rich if you can do it long enough, but what happens that one time when your shoe comes untied? We saw that between August 1st and August 5th, after the Japanese very unexpectedly raised their interest rates by 25 basis points or 0.25%. That might not sound like a lot, but older bond values go down disproportionately when rates are raised because everyone is selling the old ones to get the newer, higher yielding bonds, while simultaneously the corresponding national currency strengthens. Can you see where I'm going with this? If not, stick around. When the country whose debt you've shorted throws you a curveball, now you have to scramble to sell or buy back, in the case of shorting, whatever assets you've bought with all that money, because you're racing against other degenerate gamblers who did the same thing to convert your dollars back into the yen, which you'll be able to buy less of since the dollar is now weaker, and then simultaneously buy back their bonds that have also now lost value. So you're losing money, losing money. Keep in mind, the more people that have to buy the yen during all this further strengthens the yen and weakens the dollar, since you're selling dollars to buy yen, until those yen are sold to buy back Japanese bonds, which at least temporarily raises the value of those bonds a bit. Sound complicated? It is. But long story short, this is a trade built on leverage, built on thin air. And what's scary is, as Jack with Nobody Special Finance so thankfully pointed out, it appears that they've piled back into the trade even larger than before. What makes this particularly terrifying is that if the US rates are cut rapidly, like a 50 basis point cut, this could have the unintended effect of unwinding this trade. If I am right, and I mean if, the reason this is so selfish and a trade that would be completely bred in greed is that they could care less about all of the people's retirement accounts that will be utterly decimated when it unwinds. And I believe it will unwind. They would be taking advantage of the fact that the market on net moves up. Fund managers are rated on whether or not they've bought the best performing stocks, so naturally if the market makers temporarily force the market down, they generally have the wind at their backs helping it come back up. But leading up to August 1st, the market was already in a downtrend, making this trade even more dangerous. The unexpected raising of Japanese rates was the catalyst that set this tinderbox on fire. If multiple analysts are right and people have piled back into the short volatility and carry trade, then it is only a matter of time before this all blows up again. We just take a look at the historic high that the VIX hit just less than a month ago, and now it has compressed all the way back down around 15 to 16. This hypothesis makes the most sense to me as to why after every yield curve uninversion, we have seen a recession and typically a corresponding bear market. The mechanics behind what caused each recession before were likely different, but if they all revolve around highly over-leveraged borrowing, it could explain the consistency. And I use the yen carry trade as an example, but the potential for something to blow up could apply for any instance in which they're shorting one thing and buying another. If you agree with my hypothesis or disagree, I would love to hear your thoughts in the comments section below. As always, nothing I say is financial advice, and you should always do your own due diligence in researching the validity of any claims. Best of luck, cool cats. Stay safe, and God bless.